Hello everyone and welcome back for another of our Trader Talks videos with myself, Richard Perry, Market Analyst at Hantec Markets. Now, as ever, we need to talk about our website, and that's hmarkets.com, where you can sign up for a free demo account very quickly, and also you can sign up to a live trading account in 4 easy steps. Now, again, I'm going to be speaking to Steve Miley. Hello, Steve. How are you?
I'm very well, Richard. Yourself?
Yeah, good. Thank you. Yeah, very good. The markets are still trading around these ranges, but they're now starting to look for breakouts. And it's interesting that this dollar weakness is starting to creep in that we've all been sort of looking for. And that's a key feature of both our charts today, but yours especially with euro dollar.
Yeah, so we're certainly seeing, as you say, that broader US dollar weakness coming through, partially to do with, I think, generally a shift slightly towards more of a risk-on theme across the board as equity markets try to break out and are looking a little bit more positive. And then partially also to do with there's a belief that, maybe there's a two-tier world, I think, really in here, where we've got the US potentially now going to maybe lag behind maybe Europe and Asia. Asia obviously already to some extent, China coming out of lockdown and re-energizing.
And that's driven by the COVID infections, yeah?
Exactly, all on the back of the COVID infections in here. And Europe, we were speaking earlier on, Europe dealt with it relatively well if we compare to, say, in what's going on right now in the US with with Florida having those big spiking cases. So, the euro has been really a beneficiary of all of this, even more actually than the risk currency. So we're actually seeing euro do better than maybe, say, Australian dollar and New Zealand dollar over the last few sessions. Yeah, we've had that breakout. And if we look at the chart in here, we've got euro dollar breaking out. Well, we've got either arguably a triangle breakout or more of a range consolidation rectangle breakout on the break of the triangle and then through 113.50, and then this morning already taking out the peak that we posted back earlier in June up at 114.22, and it's all supported by rising momentum. We're getting momentum confirmations as well, so looking for further upside in here.
Yeah, I really like the euro dollar trade at the moment. I think euro generally I'm backing. Coming to the end of this week, we've got this EU recovery fund discussion between the EU leaders, and that I think is going to be a key factor pushing the euro forward if they can get that over the line. Yep. Sounds like Angela Merkel is sort of pushing for some sort of incentives for the frugal four to sign up to that, so that's a positive, and I think that's driven euro dollar higher this morning, and breaking and closing consistently above that 14.20 is a key break move, I think, that we see on euro dollar. That would open that 14.90 level. And that is a massive moment, I think. 14.90, 15 big figure on euro dollar is a really key long-term level that if euro dollar can break out through that, it really is a way.
Yeah, I agree. And then so as you take out that 114.90, 115.00 psychological option barrier, it looks like a much longer term base going back to 2019, really. And then we're looking, potential upside targets through there. I mean, the measuring targets take us up above 117 as the price objectives on the range breakout. And then we've got that peak from 2018 up at 118.15. So we could even see that high going into the second half of the summer as we go through July into August, I think.
Yeah, I think getting through this EU recovery fund will be important. You could get some volatility if it's pushed back a little bit, but I still think it's going to be coming through. And I think that is euro positive going forward. Yeah.
And talking of the dollar as well, let's talk about gold.
Yeah, thank you, Steve. What we're looking at is that gold continues to run higher. I did this trade a couple of weeks ago. I really like the breakout above 1764. We've now had consolidation of that breakout and pushing on through this uptrend, meaning that it continues to break higher. Now, this is a 5-week uptrend that I really like. It's flanked by the 13-day moving average, which is an average that I think that you like, Steve, and I'm sort of looking at on this gold as a good indicative move for the near term higher. Now, what we do is we project this gold breakout from the trading range, that April to June trading range that was around 1670 to sort of thereabouts. 1740 area, 1750. And I think that breakout was key. And holding on to that breakout means that we can project a conservative target of 1820, but a much bigger target you can bring into the 1860s potentially. So it is a really important break that I think is because you have the bullish outlook of this move. I think you're going to be looking towards the upper end of that target range. And I think that continues to hold on to the break and look strong. Now we've got the run higher that's continued to move through the weakening of the dollar. And I think that is a key move that is in line with our theme that we've got, isn't it, Steve, through the summer into the back end of this year. I think that will help the gold run higher.
Yeah, and then you've also got then the lower dollar being helped by yields as well, right?
Yeah, I think yields are being subdued, certainly by the potential of yield curve control of some description, and I think that is going to maintain also underpinned support for gold.
Yeah, I completely agree. Okay, cool. So I think, upside on gold and downside on dollar, our main themes in here, with the euro, the beneficiary on the upside for EURUSD. Sounds good for the week.
Excellent. Well, I agree. Gold 1920 is the all-time high. I don't see why that may not be touched at some stage this year. So we'll see how that goes.
Cool.
Yeah, Steve, thank you very much for another Trader Talks video, and we'll speak to you again next time. Thank you.
Thanks a lot, Richard. Bye.
Cheers.